perspective, almost 400 points now. I mean, so this is definitely looking better and better. Let me just take a quick look at where we are at in the context of the high. The high was 18,114 earlier. We are not very far away. I mean, 35, 40 points away from the day's highest point, and bulk of this fresh leg up has come in the last, 30 minutes or so of trade. Not even 30 minutes, less than that, we've kind of been on this show. All right, let's welcome in our alpha managers of the day. We have Charandeep Singh and Varun Daga, co-founders and fund managers at Girik Capital, now joining us to take some questions. Gentlemen, great to have both of you here. Thank you very much. Prashant this side. Charandeep, if I can start by asking you, you heard Deepak Shenoy earlier talking about how he thinks, at least from where we are, there are more negatives which could kind of hurt us than maybe positives which will kind of push things higher. Broadly, I just want to get a top-down view from you before we get into stuff you own and ask you sector-specific questions. Charandeep, go on.
Sure. Hi. Good afternoon, and thanks for inviting us on your show. Happy to share our perspective. I did hear about your conversation with Deepak Shenoy, and I think it's always good to be cautious from a near-term perspective. But I must add to what he said, which is from a 5-year perspective. I think there are great opportunities. India has always been a great stock picker market. And I think it's not wise to spend too much time worrying about where the market is in the near term. As managers, we're always concerned about where the earnings acceleration is going to be, where the greatness quotient is going to be high, so we can actually go and find our investors, what we're paid to do, which is find great stories, find where the earnings acceleration is, and find companies, be it large, mid, or small, that can, grow their earnings pie over a 3 to 5 year period, and make money for investors. I mean, that's all our focus is about. The rest really is just rhetoric and headlines, which we try to ignore as much as possible.
Deep, hi, good afternoon. Any thoughts on this big merger which has been announced today, HDFC Bank and HDFC? And I was going through your portfolio. You can correct me if I'm wrong, but it does look like perhaps these are not among your largest sort of weighted stocks in your portfolio. Any thoughts?
Yeah, I think I'll comment on the merger first, then I'm happy to come on to the portfolio. I think it's a good merger. It was a long time in coming, as we all know. In fact, for the last few years, people probably had forgotten about the portfolio, but or rather about the merger. But it's come as a huge surprise, and nobody was really talking about it or expecting it. You're talking about a combined entity which is going to be the most profitable entity in financial services, with a close to 53,000 crore combined profit, not assuming any synergies. Lots of cross-sell potential. And it's very synergistic, right? The cultural alignment of the entities is strong. So, we are constructive. I think, it's a reason to go out and be constructive on a name like this. It's very good. I think it's going to be good for both groups of shareholders. Although I must warn and caution that this is not advice from us. We're not in a position to tell people what to do or what not to do. But also people must realize that this is 2 years in the making. It's going to take time to get all the approvals and to get consummation going. From our portfolio perspective, like I said, I think this could be something that could be looked at more favorably, and a good reason to take weightages up. So I mean, that's really in short summation as to how we view the merger at Girik.
All right, Charandeep, but I'm just looking at your portfolio, and from the holdings that we have, it appears that you hold the other names. That's ICICI Bank, SBI, Bajaj Finance. Do you think competitive intensity goes up and it could put pressure on these names? Or do you think that, this merger with consolidation is good for the industry on the whole and everyone will prosper?
I think it's already a very consolidated industry. If you now look at it, it's always been, since 95, it's been a case of the PSU banks losing market share to the private guys. In fact, now what's happened over COVID is you found that there are maybe 3 or 4 large private players that have taken bulk of the market amongst the private sector players. So, you're really talking about a 4 to 5 bank industry anyways. It's between these guys. I think it will help HDFC Bank's numbers because, pulling synergies out of this would be relatively easier for them. Had they merged with someone outside or a third-party organization, it would have been much harder. So pulling synergies from a group company would be much easier, culturally aligned, like I said. So I think it's going to be really good for them. There's no question. And I think, the others it's status quo for the others, really, isn't it? I mean, they're playing the game they're playing, but I think it's really good for HDFC.
Varun, welcome to the conversation. Your top holding is Hindalco with about a 5.6% allocation as far as I can see. Correct me if I'm wrong. So what is the story there? Because if you like the entire space, is it something very specifically about what Hindalco is doing, or is it the cycle, the entire metal cycle that you like, which Hindalco is very much part of? And if this latter is the case, why only Hindalco? Why not, maybe more names?
No, thank you. Thank you for having us. So yeah, good question. So metals actually came up on our screeners about almost a year and a half ago. And we were really shocked when these stocks came up on our screeners because, in fact, for the past decade, I don't think anybody invested in metals. And when we looked at anyone's portfolio, it was pretty much a bad word. When we looked at Hindalco, Tata Steel, in fact, we owned both initially. In fact, even now we own both. And we really saw that, with the cycle turning, some of these companies could really make a lot of money, and the earnings acceleration was really there. It was completely a contrarian bet at that time, but we really thought that these were businesses which were getting into an upcycle, and for most of the market, it was very hard to understand these businesses. So we took our time to understand these businesses, and I mean, it was amazing that in that period, some of these financials had no returns, and some of these metals have doubled. So it was just amazing to see how so-called cyclical stocks could also make money, and we feel the trend is still on. I think they are out there to make large profits, and the pool of profits are big, and globally we are seeing that money is flowing to some of these commodities stocks. So we continue to remain bullish. Why specifically Hindalco? Because we like the aluminium cycle, we like the stability of earnings in Hindalco, what they're doing with Novelis. We thought it was a very, very steady business. The more demand for aluminium, the less of supply of aluminium. So we thought it was in the right spot at the right time, and we went for that.
Okay, fair point. Now, Varun, good afternoon. You can, just looking at again your sectoral allocation, IT is actually looks like is a bit of an underweight for you, and I don't see any big IT names among your top holdings. Of course, they can be part of other holdings, but at least not in the top holdings is what I can see. Thoughts here?
No, actually, IT is big. In fact, it's one of our, maybe I think you're looking at a little dated portfolio, but IT is one of our top sectors. In fact, some of the names like Infosys and all are some of our top holdings. So we are. I mean, to sum it, we are quite bullish on IT, and it's been on our radar, on our screeners for a long time, and we feel the story here is very, very secular, and we continue to remain overweight on IT. So I think, yeah.
Got it. Okay, so maybe we have a bit of a dated portfolio. You have a large exposure to IT, is what you're saying. Charandeep, getting back to you. What's your cash holding? Is it 24% right now?
Oh, no, it's right now must be about 10% or 11%. 10%.
Okay, 10 or 11%. And do you intend to keep it that way, or do you intend to deploy it?
Right. It's, we're always intending to deploy. So at any given point of time, we've got ideas under research. We're working hard on certain names that we like. But whether they make the cut, whether they make the investment cut or no, is always to be determined. So cash is not a function of a market call, I must tell you. Cash is a function of two things. One is risk management, right? And availability of opportunities. So it's a combination of both things for us. We never take cash calls, almost never. I mean, I can't remember in 13 years that we've really gone and said, oh, we got to overweight cash because we're worried about the market. It's largely because, our risk management kicks in. And sometimes, we are forced to take losses, because we're very disciplined about that as a fund house, and that's really largely kept us out of trouble for many years and made sure the equity returns are fairly smooth to our investors, and also about finding new opportunities. which keep coming up, mind you. And like I said, it's a rotating wheel. You know, we're always looking for new ideas, and it's a matter of time before we find them. So I think, you know, we're always in deployment mode, to answer your question. It's not that we are short of ideas. We just need to close them.
Quickly then, before we let you go, the new age themes, some of them are down 50, 70%. I think you were, if I'm not mistaken, one of those names I think found its way into your portfolio, Nykaa. Not too sure about that. You could confirm or deny it. But given that you're sitting on some cash, you're looking to deploy, a lot of ideas out there, will some of these stocks be part of those ideas?
We've never had Nykaa in our portfolio, so no. I mean, and I think we're open. We're open to looking at anything. You know, we follow a very rigorous screening process, which is which is primary for us.
Okay.
And we don't really look for stocks like that. You know, if something's fallen 50 or 70%, it's many times a reason just to stay away from it, not necessarily a reason to go and buy it. So you have to make sure that you're buying it for the right reasons.
Yeah, absolutely, Charandeep. You know what my question to you is, given that some of these stocks are available, maybe the price correction is only making it a little bit more attractive. Some of these businesses could be good. So not solely the price, but getting some of these stocks at a bit of a discount. Will you look at these new age themes, or is it a complete no-no as of now? Go ahead.
No, it really depends. I think we would look. We are very open-minded, I must tell you. And again, with every passing year, it's harder and harder to be open-minded. But I can tell you, we are constantly trying to be more and more open-minded. We did have some Zomato as part of our portfolio, and risk management kicked in. We have to protect downside returns, but I will tell you that some of these are just phenomenal businesses. It's just about the stars aligning in terms of getting the earnings acceleration right. Okay. And in terms of getting the value on the table right. If that's on the table, we're not shy to get into any of these. For us, it's
I guess some of them, they became like the darlings of the market, and then from being there, they became the most hated stocks. I guess the reality is somewhere in the middle.
Yeah.
They are great businesses which were extremely overvalued.
Right.
Because the earnings visibility was far away.
Right.
And I guess when that starts, like Charandeep said, when the stars get aligned, I'm sure these businesses will find their feet.
Okay.
Okay, gentlemen, thanks a lot for joining us. Though I must say, that IT weight, I think we've taken from your last presentation, so perhaps maybe that can be updated a bit. I must say, though, that your fund has really outperformed big time. I think since 2009, which is when you have come out with your fund, your growth has been 20% compared to 10% for the Nifty, 11% for the mid-cap index, and 9% for the small cap. And over a 1 year period, 25% return, 5 years, 17%. Of course, that would be CAGR. So a great performance, gentlemen, and we hope you can continue doing that for your investors. Thanks a lot for joining us today on CNBC TV 18.